Good afternoon, everyone. We are going to give some latecomers a little bit of extra time to join the meeting. So we're going to start in about 2 minutes. And I see that we have some more people joined. We're just going to give people a little bit more time, so at about another minute, then we'll begin. All right, we're just going to give it a little 30 more seconds, then we'll begin. All right, good afternoon, everyone. Welcome to this presentation focusing on the financial challenges of the sandwich generation. My name is Chris Mcallister. I'm a certified financial planner professional and retirement income specialist for Prudential. As we talk today, there might be some questions that you'd like to ask. So you can feel free to use the Q&A chat box in the meeting to write down your questions, and we'll answer them during the Q&A section at the end of the presentation. Before we begin, I'd like to just kind of take a quick poll. Now, how many of you have children living at home or away at college? How many of you have one or more parents that you're caring for today? How many of you are part of this sandwich generation? And if any of you don't feel or aren't sure what that is, how many of you are not sure what this sandwich generation is? Okay. So in today's session, I plan to cover the realities of being a member of the sandwich generation and strategies that you can use to care for your parents, children, and most importantly, yourself. So let's get started. First, let's talk about what it means to be in the sandwich generation. So how did the sandwich generation come to be? Demographic trends typically explain the reasons why many of us will become part of the sandwich generation. To start, medical advancements have allowed people to live longer than ever before, which puts extra strain on their retirement savings. And as our parents continue to get older, they may require serious health issues to be addressed and are going to need our help. Also, many people are deciding to get married and have children later in life. As such, many middle-aged adults are more likely to still have children in the home, as their parents also require the care. And more adult children are choosing to live at home during college years or return to home after college. Finally, middle-aged adults in general are typically at the peak of their careers and face extensive demands in the workplace. So this can also add to the feelings of being sandwiched for this generation. So it leaves a lot of sandwich generation people feeling like they're just caught in the middle. And family caregiving is still largely women's work. In fact, nearly 2/3 of caregivers are women. Part of this is because men prefer to pay for the care versus give it. So for those of you who are women in the audience and you're providing care and looking for help from your brothers, you might have an easier time asking them to cover costs versus asking them to provide care. Knowing these innate preferences can certainly help reduce the stress between the siblings. For example, if you are stressed out from giving round-the-clock care, ask if they would mind paying for a nurse to come and relieve you from time to time. Regardless of gender, caregivers often find themselves stressed by the decisions such as how to split their time dealing with their children's and parents' needs, find time for one's marriage, find time for personal needs, find the needed resources to take care of oneself, the children, and their parents, deal with the guilt of not having enough time to do everything, and address health care options such as Medicare, supplemental policies, and long-term care for their parents. One of the most important things to keep in mind when caring for aging parents is you don't have to do it alone. Ask for help. So it's easy to feel squeezed when facing decisions about how and where you're going to help your aging parent receive care. Things you're going to want to consider will include safety issues. Can your parent get around on their own? Medical issues. Is your parent able to take medications as directed, or do they need help? Costs. Is your parent able to keep up with mortgage and insurance premiums, as well as all the other expenses they have when owning a home and for their general lifestyle? And then medical condition. If your parents are showing signs of Alzheimer's or Parkinson's, you need to make adequate considerations for care. During this time, if you are giving care to your parents, your kids might start to feel a little bit left out. So some things I always recommend to people is make time for your children, plan special one-on-one activity or outings. Also, you can involve them in caregiving tasks. If you can involve your child and kind of give them some responsibility, they'll feel like they have something at stake, and they'll feel like they're an important part of the process. Also, make a family plan and just make sure that children feel involved in the decision-making as well as the discussions of feelings, struggles, and expectations. Make sure they still have their own space. And then finally, be sure to pitch in with additional tasks around the house. And when they do that, make sure they know that you're grateful for the sacrifices that they're making. So with older children, on the other hand, it may be time to start talking about college. Encourage realistic expectations about funding options and the college they may need to attend. Your kids may also have to settle for less than they wanted, or at least get a job to help meet costs, especially since you need to continue to save for retirement and might need money to help care for your parents. So when it comes to college savings, there's usually two types of plans. The first is the 529. So a 529 plan just allows the account holder to establish a college savings account for a beneficiary and use that money for tuition, room and board, mandatory fees, required books, and computers. The money contributed to the account is usually invested in stock or bond funds or in money market funds, similar to like the options you have in your 401k. And the earnings are not subject to federal tax, as long as it's used for qualified college expenses. The 529 plans, new to them, can actually now be used as well for K through 12 expenses. So if you have those same like tuition, books, computers, those kind of fees for like say a private school or just to supplement the public school expenses that you might have, you can actually use 529 funds for it. And a lot of the time, states will offer you tax deductions for contributing it into. So if you have any questions about funding it or taking advantage, if you use a 529 correctly with some additional tax planning, you can actually reduce your education expenses by, I've seen upwards of like 20–25%. So there are a few other options of paying for college. A lot of people know about the Coverdell Education Savings Accounts, or ESAs. Their unique feature was that they could be used for elementary school, so K through 12. But ever since they made the changes to the 529, I don't really see a lot of ESAs. Their contribution limit is only about $2,000. So there's really not a lot of people that are opening up new ESAs these days, because in my opinion, the 529 is just the better option. Other things you can do is you can also transfer assets into an UGMA or an UTMA. You can also use a Roth IRA. I don't think, while these are effective, they might not be the best option because they have their own kind of terms and conditions you must meet. So what I always encourage is, talk to a financial advisor or talk to somebody that plans for college, and they can kind of help point you out in the right direction. If you do have young adult children that do come home after college, they're called boomerang kids or maybe failure to launch. If they do return home, you do want to make sure that you make them contribute. So here are some ideas that we have that can help them, instead of getting, let's say, a free ride, they can actually make use of their time at home. One of the things that a friend of mine did was his dad made him pay rent, but he felt bad taking the money, so he just saved it, and then when the kid finally got their job and was ready to move out, he had just stored everything in a savings account and gave it back to them as like a down payment for a house or as an emergency fund. That's something that you can do if you are going to bill your kids. That's something you can do to kind of make sure that they still have that money when they need it. While sandwich generation caregivers face some issues foreign to past generations, there are ways to help lower your stress level and ease your financial burden if you are feeling the squeeze. In particular, you may want to consider updating your financial goals, making a budget with input from your children and parents, and working to ensure you stay on top of debt. Also important to invest wisely. Keep an emergency fund and to discuss healthcare options with your parents. And you'll want to ensure your assets are adequately insured. You have an estate planning strategy and that your claim tax benefits. They apply to your situation. You may be able to claim them as a dependent if they make less than $3,900 per year, which does not include Social Security payments. And then, of course, put yourself first financially too. Let's take a look at some of these important strategies. Now let's talk about some ways that you can update your financial goals. Maintaining control of debt. Keep your debt under control. Consumer debt, things like car payments and credit cards, should account for no more than 20% of your take-home pay. The best thing for you and your budget is to start paying off debt now, especially where there are high interest rates. Here are a few strategies to think about related to managing and reducing debt. First, start by making extra payments to your credit cards or creditors with high interest rates. By paying off these debts sooner, you'll be able to put more money away for your future financial wellness. And when you get a pay raise or bonus, use a portion of it to pay down your outstanding debt. It can also be helpful to consolidate your debt, if practical, as you may receive a lower overall interest rate. Saying that you'll eliminate debt from your life might not be a realistic goal. A more achievable goal may be to steer clear of new debt. With uncertainty approaching, you might want to avoid the lure of your dream home in lieu of a more secure future for your family. Consider what you really need rather than what you want when making major buying decisions requiring long-term financial commitments. If you are not doing so already, start tracking your expenses and staying on top of your budget. Keeping a monthly expense summary like the one shown on this slide might help. Now let's talk about some smart places to put your money. maintaining an emergency fund. At this point in your life, it is completely reasonable to save up so you have at least 3 to 6 months of living expenses in your savings account. That's your emergency money, cash you can tap when everything goes wrong. Don't rely on your credit card to bail you out. It's useless in the event of identity theft and in a true financial crisis. Keep a healthy emergency fund and replenish it whenever you use it. Make sure it includes enough to cover 6 months of expenses, and remember, it's better to save a little at a time than nothing at all. Now let's talk a little more about college costs. We mentioned loans before. How much will it cost to send a child to college in 18 years, and how much do you need to save? A 4-year college degree is estimated to cost about $443,000 for students enrolling in 2038. If tuition increases an average of 7% a year until then, assuming you have no current college savings, monthly deposits of $875 into a 529 or other college savings plan earning an after-tax return of 7% will be needed to achieve that kind of balance. So this is just an average number, and clearly your costs could be lower. Nonetheless, when considering this kind of higher education price tag for your child, it's a good idea to start saving as soon as possible, especially if you're feeling sandwiched. With costs projected to escalate as much as we've seen, it's never too early to start your child's college fund. Waiting to start will cost you. The closer you get to your child's college years, the more you will have to invest in order to reach your goal of $50,000, $100,000, or even $150,000. This chart here shows monthly investment figures based on an interest rate of 6% compounded monthly. By starting your child's college fund now, you may be able to put away less per month, helping you budget now and in the future when the tuition bills start to come. So discuss healthcare options with parents. Where your aging loved ones are concerned, discuss care options with them early on. It might be difficult to approach your parents with this topic, but planning early can pay off both financially and emotionally. If you explore possibilities while your parents are still healthy, more options may be available. Plus, your parents can help you work towards mutually desired goals. There are several care options available for aging parents. Here are some of the most common. Home health care provides seniors with medical and mobility difficulties with home health aides who visit on a regular basis to help them with bathing, preparation of meals, house cleaning, supervision of medication, or transportation to and from their appointments. Adult daycare offers activities, recreation, meals, and supervision for your parents while you're at work. Most adult daycare centers offer transportation to and from to the adult daycare center as well. Group homes. This type of environment is usually located in a residential home. Elderly individuals in a group home environment share rooms. Often these homes are supervised and maintained by employees who help clean and cook, but who may not be trained in medical or healthcare. This type of facility is also known as a board and care home. Assisted living offers apartments and services for those who need a little extra supervision or help to dealing with daily tasks and challenges. And then finally, long-term care facilities offer private and shared rooms in a facility where round-the-clock care is provided for individuals that need help with daily living activities. But make sure you also become knowledgeable about government programs such as Medicare, Medicaid, and long-term care. You might even want to consider enlisting the services of a geriatric care manager. So estate planning is another tough topic you'll want to tackle with aging loved ones, and actually for a lot of you guys, especially if you're in the Foreign Service. So let's review some common elements of estate planning and their documents. So the first is a will. This is the most basic of estate planning document. Trust is a legal entity that owns assets on behalf of the grantor for the benefit of beneficiaries and is managed by a trustee. Now let's also talk about beneficiaries. So beneficiary designations on retirement plans, IRAs, annuities, and life insurance policies control the disposition of those assets. In addition, you can add payable on death or POD designations can be made on CDs, bonds, and other investments. These are important. Knowing the beneficiaries and the setting up trusts can be important because they actually escape probate. So the probate process is the legal process through which assets are inherited. Generally, we want to avoid it because it can tie up property for a long time. It's also expensive, and what happens typically becomes public record. So using trusts, using beneficiary designations are an effective way to avoid this altogether. So I encourage you to use this wealth transfer checklist and to think about the importance of each item. Transferring one's estate or wealth of any amount can be complicated. So therefore, I recommend consulting with an attorney with expertise in trust, estates, and wills as an important part of your planning. Additionally, involve a tax and financial professional that can help provide invaluable assistance. All right, switching gears to retirement. So don't get so caught up in taking care of your loved one's physical and financial well-being that you forget your own. So put yourself first. Especially as you count down to the end of your career, make sure contributing to your retirement plan remains a high priority among your financial obligations. Consider retirement savings over college savings. Remember that the best financial gift you can give your kids is to not financially burden them in the future. Also, no parent wants to ask their child to pay for their housing or medical bills in retirement. This means you must choose to not pay for as much of their college education, so be it. When choosing between retirement savings and college savings, you need to choose retirement savings. You will never be able to recoup what you lose by not putting your money into your 401ks and Roth IRAs. While you can finance many things in life, it's hard to put retirement on a credit card. So don't be a sandwich generation martyr by putting your own needs after those of your adult children or aging parents. You'll be a much more valuable parent and child with your own financial house in order. It's also important to make sure your own assets are adequately protected. Does anyone know how to protect your income and assets for risk? Get insurance, you're correct. Insurance transfers the risk from you and your family to an insurance company. Here are some types of insurance you should consider. Life insurance. It provides a death benefit for your loved ones when you die, to replace the lost income, pay any outstanding debts, pay tax obligations, and funeral costs. Disability income insurance provides benefits that replace part of your lost income when you become unable to work due to illness or injury. If you become injured or ill and can no longer work, disability insurance generally does not fully replace your income during your disability. It only replaces a portion of your income. Home and auto insurance protects your property from damage and covers you from liability claims that result from accidents and injuries caused by you. If you have significant assets, you should consider an umbrella policy which provides extra coverage over and beyond your auto and home coverage. Health insurance. It's mandatory now, but even if it wasn't, it's critical to safeguard your assets from the high cost of health care, both routine and unexpected. Long-term care insurance. You can pay a certain dollar amount per day for a set period of time for the type of long-term care described in the policy. Depending on the benefits selected, care can be provided in a variety of settings, such as your home, assisted living facilities, and nursing homes. Best time to purchase is when you are healthy enough to qualify for it. Finally, there are some instances when insurance alone might not provide all the protection you need, and other strategies such as trusts and business entities may be useful. So revisit your disability and life insurance coverage to make sure your family is protected in case you are no longer able to work or suffer an untimely death. Long-term care insurance for you and your parents might also be an option to help offset the asset draining cost of nursing home or home health care. All right, so life stage concerns. So you can protect your assets with a variety of kinds of insurance. Keeping in mind the stage you're in at your life may require different types of coverage. As you can see, our concerns and our insurance needs change as we age. As children, our parents care for us and no one depends on us for financial support. We also don't own a lot of material assets, so our need to be insured is low. When we're just starting out on our own, perhaps after college or getting married, our insurance needs and liabilities increase. Perhaps as our family grows, we purchase big-ticket items like automobiles or homes, so there is a need to protect those assets with insurance. Our families depend on our income to pay for the home and help reach their goals. But eventually, the house gets paid off, the children mature and move out, and our retirement is in sight. While the need to protect income in debt may decrease, a need to protect your estate and to protect yourself and your children against the expenses of long-term care increases. If something happens to you, who will take care of your children and your parents? There are two kinds of life insurance, term and permanent. We're going to talk about these in a very generalized way, so the descriptions will not relate specifically to anything or any specific product. Term insurance is temporary and lasts for a term. That's the defined period of time. Most commonly, the premiums are level for a time, usually 10 or 20 years, followed by a period of annually increasing premiums. Insurance companies all have variations. Some might have a 15-year policy or a 30-year policy, for example. It's important to note that you'll generally need to qualify for a new policy once the term expires. These term policies may be a good way to provide a death benefit that can help your loved ones with expenses. Permanent insurance can last for an indefinite period of time, as long as you pay the premiums when due and don't take any substantial loans or withdrawals. So if you want to help your beneficiaries have money to pay your estate taxes or your funeral expenses, whether you die at age 65 or 95, then a permanent policy can be a good choice. There are several common types of permanent life insurance, including traditional whole life, universal life, survivorship, and variable. We find that many people have needs for both term and permanent life insurance, a combination. Also, the type that's a good fit for you can also depend on the details of the specific policy you get and where you are in your life. Please note this is not a complete comparison between these two products. It doesn't include all benefits, fees, expenses, conditions, limitations, or any restrictions that might exist. Long-term care insurance can be an important part of your overall financial wellness strategy. Having to pay for long-term care out of pocket is very expensive and can potentially wipe out all of your savings and income. Long-term care insurance helps to mitigate the risks and ensure you will have the coverage you need while still being able to maintain your assets and income stream. So who's it for? People who want to maintain assets and income streams and have the peace of mind that should they need long-term care services, they have a policy to help cover the cost. Also, individuals who don't want to rely on their children or family members to take care of them, should it come to that. So what is long-term care insurance? Long-term care insurance involves the help or supervision provided for someone with severe cognitive impairment or a chronic illness or disability that prevents them from performing at least 2 activities of daily living. Activities of daily living include bathing, dressing, eating, toileting, transferring, and continence. Long-term care insurance will pay a stated amount of an insured's long-term care costs when the insured is certified as a chronically ill individual by a licensed healthcare practitioner. Long-term care policies generally help cover costs associated with home care, assisted living, adult daycare, respite care, hospice care, nursing homes, and Alzheimer's facilities, with stated maximum benefits and a stated period of coverage ranging from a stated number of years to lifetime coverage. Long-term care insurance is generally available to people who are 18 or older, as accidents and illnesses can happen to anyone at any time. Long-term care can greatly impact your finances and the quality of both your life and the lives of your loved ones, why it's important to plan for long-term care well before you need it. Keep in mind that long-term care services can be costly. You may need a variety of sources to pay for them. You can combine long-term care insurance with other sources such as Medicare and Medicaid to cover the cost of long-term care. Also, keep in mind that policy features can be complex, so if you're considering long-term care, be sure to read all the fine print. All right, switching to Medicare. So costs related to medical care represent the second largest expense behind housing costs during retirement. Now let's review Medicare and the role it can play on your overall financial wellness. In the following slides, we're going to cover your Medicare options, Parts A, B, C, and D, supplemental insurance, and how enrollment works. There is a lot to Medicare, so we're going to dive right in. Medicare is the federal health insurance program for people who are age 65 and older, certain younger people with disabilities, and people with end-stage renal disease. Medicare provides federal health insurance to about 61 million people. About 52 million of those are 65 and older. So people become eligible for Medicare on the basis of age when they reach 65. Disabled individuals generally become eligible for the program 24 months after they qualify for benefits under Social Security's disability insurance program. In general, a beneficiary or the beneficiary's spouse must have worked and paid sufficient Medicare payroll taxes for a specified number of years, 10 years or 40 quarters for most elderly beneficiaries. You must be a permanent resident or U.S. citizen to be eligible for Medicare. There are a number of options available to you under the Medicare program. It can be confusing to keep it all straight, so please feel free to ask any questions you may have. I'm here to educate. We will briefly touch on Parts A, B, C, and D, and then take a deeper dive into each of the following slides. Medicare Part A helps cover inpatient care in hospitals, skilled nursing facility, hospice, and home health care, and is free. Medicare Part B helps cover doctors and other healthcare provider services, hospital outpatient care, durable medical equipment, home health care, and preventative services. There's a premium for Part B, which is at least $100 per month. Medicare Part C, also known as Medicare Advantage plans, includes all benefits and services covered under Part A and Part B. Part C plans are run by Medicare-approved private insurance companies and usually include Medicare prescription drug coverage, which is Part D, as well as extra benefits and services for an extra cost. Medicare Part D helps cover the cost of prescription drugs. Part D plans are offered by Medicare-approved private insurance companies. A Medicare supplement insurance policy, also known as a Medigap, are private health insurance plans that's designed to supplement original Medicare, so Parts A and B. The Centers for Medicare and Medicaid Services is the federal agency that regulates these Medigap plans, and the CMS determines what must be covered by these Medigap plans and coordinates them with Medicare Part A and Part B. Many workers covered by company health plans may still benefit from enrolling for Medicare, especially when you consider that individuals can take Parts A and B at different times. It's important to have all of your financial paperwork and information accessible in a central location, not only for your own convenience, but also to make it easy for your loved ones in the event that they need it. To help make this easier, Prudential has developed the Life Stages Folio, so you can easily compile this information and contain it in one place. So take a few minutes when you can to review the information that should be included in this document. If you don't have the document, you can send an email to us, and we will take care of getting it sent out to you. When you're using this, clearly it's a lengthy document, but it's extremely important that it's filled in as completely as possible and kept up to date. You and your loved ones will be thankful that it's there when you need it. Finally, since you obviously have some very important information here, I'd recommend that you keep it in a safe and secure place, such as a safe or safety deposit box. And if you do, make sure that the people that need access to it have access to it. So the sandwich period can be a major life trial, but with some careful planning and clear communication, it's a period that can be rewarding too. So here are some tips for success. So one, draw strength from your faith. So turning to your faith can help you emotionally, spiritually, and physically. Also, churches and synagogues and other faith-based organizations typically have volunteers that will help you. You can also set aside time for yourself. The emotional stress of caring for others can be overwhelming, so try just setting aside 1 hour a day to do something that you like to do. Seek family support, so maintain open communication with immediate family members and siblings, and let them know how you're feeling. Doing so gives you a chance to ask for help as well. Talk to your employer. So the majority of people are often employed full-time, so the responsibilities of caregiving inevitably will affect your work schedule. And one of the biggest mistakes I see is that caregivers try to hide it from their employers. And generally, when they talk to their supervisor about their care responsibilities, they're usually able to find some flexibility. Get professional assistance. So talk to your loved one's doctors about what to expect regarding his or her condition, and ask about concerns related to medications, schedules, diet, and exercise. Keep your financial home in order, so you can continue to achieve your financial goals despite juggling the care of others. You're going to want to organize important papers, take inventory of your parents' assets and consolidate their financial accounts. Ask for help and say yes when people offer it. Make a family plan, involving everyone and discussing your feelings, your struggles, and expectations and finances as appropriate. And then finally, stay in touch with friends. Socialization is going to be more important than you think. Finally, here are some additional resources that you can use to help you care for your parents. The AARP website, Elder Care Locator, Meals on Wheels, Aging Life Care Association. By taking the time now to plan for your financial future, you gain peace of mind knowing that you are doing all you can to provide for yourself, your family, and most importantly, to ensure your dreams come true. Hopefully you feel more informed about the financial challenges of the sandwich generation. So please now remain on the line to better understand the group life offerings that are available to you as a member of AFSPA.
Thanks so much for that portion of the presentation, Chris. That was really great. And good afternoon or good morning to members of AFSPA, both foreign and domestic. I am Nina Matias. I'm the Vice President and Account Executive with the Prudential Group Insurance Department. And I have the distinct pleasure, number one, as serving as the relationship manager between AFSPA and Prudential. And more importantly, I have the distinct pleasure once again to be with you all during Life Insurance Awareness Month. Very briefly, before I hop into the details of the AFSPA benefits program, I think it's important just to point out that September is Life Insurance Awareness Month, and that's an industry-wide campaign. Every September this happens, and we're here to help educate you all on the importance of life insurance and the role it helps playing in protecting your families and your financial security. Without further ado, a couple things that I always like to point out during Life Insurance Awareness Month, because it's very easy to think you're fine, you don't need it, you don't have to worry about it, or it's just too much money. And truly, we found that many consumers think that life insurance costs about 3 times more than it actually costs, and about 40% of people don't even realize how much coverage they need or what type of life insurance to have. Additionally, more than 1/3 of all households would feel an adverse financial impact within 1 month if a primary wage earner died. And I share all this not to frighten anybody, not as scare tactics, but truly to underscore the fact that one of the best places to start are through your member benefits that are provided to you through AFSPA. And what we want to walk you through today are the coverages that you can enroll for. And the first is the group enhanced life insurance. So that's member term life insurance. And as you can see on the slide here, you can enroll starting at the age of 19, and you can newly enroll for coverage all the way through 59. The coverage ranges in $50,000 increments all the way up to $600,000. More importantly, for those of you that are newer members, you can apply for up to as much as $200,000 without having to complete any medical evidence. That means no health questions. If you apply within 60 days of your date of hire, or more recently, we've also added within 60 days of a specified life event. So if you get married, have the birth of a child, adopt a child, it's really, really important to take a step back and understand if you have enough insurance. And if you don't, it's a great time to take the opportunity of the benefits that AFSPA makes available to you, specifically being able to get up to $200,000 in coverage for yourself without having to answer medical questions. Additionally, as you can see here on the slide, coverage is also available for your spouse or domestic partner, as well as dependent children. So for your spouse and domestic partner, you can elect up to half of what you're able to get, which is $300,000. And again, if it's happening within 60 days of your hire date as a member, they can receive up to $50,000 without medical underwriting. So again, for those of you who are newer to the AFSPA program, welcome, and don't hesitate to take action. Similarly, you can elect coverage for your dependent children in an increment of either $10,000 or $20,000, and that is always without medical underwriting. Another really positive feature to the GEL or Group Enhanced Life program is the accelerated benefit option. If you enroll into the GEL plan for any increment, the accelerated benefit option is just another feature that you will automatically be eligible for at no additional cost. The intent of this portion, this accelerated benefit option, is to allow you to take a portion of your life insurance while living if you're unfortunately diagnosed with a terminal illness and have a life expectancy of 12 months or less, or if you have a chronic illness and cannot perform at least 2 of the 6 what we call activities of daily living for at least 90 days. So those can be things like bathing, toileting, feeding yourself, or if you additionally have a severe cognitive impairment that requires supervision, you can receive up to 50% of your amount to a maximum of $50,000. So this is another feature truly that's intended to help you take a portion of your benefit out during your living years if you meet any of the criteria we've just gone over to help you use that in any way possible. Some members look at that as a way to make sure that certain bills are handled. Others may just decide that they want to use that to enjoy a period of time with their friends and family without having to worry about financial burdens. This is not embedded in every term life insurance program, so it's just another great feature in a time of need to make sure that the benefit is there for you and your family to adequately protect you. Okay, everybody, in addition to the Group Enhanced Life Insurance, let's talk about some of the other benefit plans under AFSPA that you may be eligible for. The first one is IBP, or the Immediate Benefit Plan. Now, this is only available to specific agencies. However, the intent for the IBP plan isn't heard in the words. It's there to allow you to receive a lump sum of either $15,000 or $20,000, depending on what you've enrolled for, to help cover immediate expenses. The intent of the IBP is to get a portion of the proceeds to your loved ones, your beneficiaries, as quickly as possible so that they can help address any imminent and immediate financial burdens, which could include funeral arrangements, family visits, final medical expenses, and or unforeseen travel expenses. Additionally, and I can't underscore enough, you are all eligible to enroll for accidental death and dismemberment, or AD&D. The name sounds fairly gruesome, and sometimes, the benefit is inherent in the name. This provides a schedule of benefit payout in the event of your death as the result of an accident or for certain losses, including dismemberment, paralysis, loss of sight, loss of hearing, and your AFSPA benefits team can help explain in detail what the schedule of benefits look like. But coverage amounts for AD&D range from $10,000 to $600,000, and I can't underscore enough where it says it's great to supplement life insurance. Please keep that in mind. It's less expensive than group enhanced life insurance, and it's guaranteed issue. There are no medical questions, and if there's a loss of life, as I've mentioned previously, due to an accident, or you had a severe injury or loss of limb or paralysis, then you would be covered for an AD&D benefit. Additionally, and again, I just want to really point out, God forbid you pass away in an accident and you're enrolled in either IBP if you're eligible or the jail plan, and you're also enrolled in AD&D, you will receive both benefits. For example, if you have $600,000 in AD&D and $600,000 in the jail plan, your beneficiaries would receive $1.2 million should you pass away during an accident. So it's very quick to enroll. Again, it's less expensive, and it's a line of coverage that we all really should consider having. Lastly, critical illness insurance. This is one of the more recent benefits that I'm pleased to have been able to work with the AFSPA team to make available to all of you. It may be limited by certain states depending on your residence, but we're working with our regulators to unlock more and more every day. However, critical illness is not life insurance. Critical illness is a really great supplemental health benefit that allows you time to focus more on your recovery rather than your finances. If you are diagnosed with one of the major conditions that you see here on the screen, from invasive cancer all the way down to coronary artery bypass surgery, Prudential will provide you a lump sum benefit up to $100,000 when you're diagnosed with a covered condition. It can be used for anything. We do not police the payout of those benefits, so whether it be a deductible, a copay, rent, mortgage, groceries, even child care or adult care for that matter, seeing as we just gone through a sandwich generation webinar, it's truly yours to use as you see fit. We have a fast and easy claim process, and provided there's a diagnosis and Prudential receives proof of that diagnosis, the intent is to make sure that you receive your payment promptly to help you use that fluid benefit for whatever it may be that you need. To members far and wide, thank you so much for listening to our presentation today. As I opened, I'll close with saying I hope that this gave you a greater appreciation for the need for life insurance alongside the many other resources and tidbits that Chris shared with you in his presentation. This is how you contact AFSPA and the benefits team. I'm pleased to be their partner, and I know that they work very closely to make sure that they're providing you not only with a competitive suite of benefits, but a suite of benefits that's meaningful to all of you. If you have any questions about enrollment or about the more details related to the benefits for which you can enroll, here is how you can contact the AFSPA benefits team. Thank you so much for your time. And in a moment, we're going to proceed with Q&A. Okay, in a moment, Chris and I are going to start reading through the awesome questions that many of you submitted on the chat line, so thank you so much. I'll just reiterate that if we unfortunately don't get to all of your questions today, this webinar, the full webinar with the slides, alongside any Q&A, both that we've asked and answered today and those that we didn't get to, will be made available to the AFSPA team and therefore to all of you in about 1 to 2 weeks. So once again, thank you so much, and we're going to dive right into the questions and answers right now. Have a great afternoon, everybody. All right, and thanks again. We're going to jump right into some of the great questions that you've all asked. So the first one, Chris and I are going to kind of tag team. And the first one, Chris, I'll just kick it over to you, was a request for a PDF of the assets transfer checklist. And, before I ask Chris, whether or not we can extract that, I will just share that this entire recorded session, alongside a transcript, as I mentioned earlier, of the Q&A, will be provided to you all. But, Chris, is there a way to get a PDF specifically of the checklist?
Yeah, I can send that PDF to you. I can also do the same thing for the Life Stages Folio. And then I guess you guys will take care of getting it sent out to all the attendees.
Yeah, that'll sound great. Yeah, we can just include that right when we get back to the AFSPA team with all of the details, including the transcript. So thank you so much. Next question that we have is, do you have more information about a gap health insurance policy? Is this the correct name, or is it called disability insurance? Fabulous question. I think this one came in probably before I spoke a little bit about the AFSPA-specific benefits. So for the benefit of the broader group, gap insurance typically is a supplemental health plan, and it's intended to work alongside a high-deductible major medical plan, typically to help offset the costs, right, of the high deductible. So while critical insurance is not necessarily a gap insurance policy, let me say gap health is not disability, but the critical illness plan that I was speaking about just a bit ago that is provided under the group insurance umbrella works similarly in some regard, in that it does, you can receive those funds, as I shared, and use them in any way possible. But a lot of folks that do have one of the qualifying critical illnesses do tend to use that money to help offset the high deductible plan. So not quite gap health insurance, definitely not disability, but critical illness is used in that manner by a lot of individuals. But again, we don't police that money. And Chris, is there anything else you want that from your perspective and your experience that you'd like to add to that?
Yeah, when I read that question, I also wasn't sure if they were referring to like Medicare gap policies or supplemental like disability policies. Mm-hmm. So if it's a Medigap policy, you would just get that through a health insurance broker. If you are looking for disability insurance, you could get that through pretty much just about any insurance agent that's licensed to do so. If it's something that you are curious about or you want to get some quotes on those latter two, I believe you can fill in the survey. You can request to be contacted, and I am licensed for both of those, so I can reach out to you and I can get you some quotes if you need it.
Thank you. Another question that we have is, why would someone need accidental death and dismemberment insurance? Shouldn't life insurance be enough? And I just want to underscore something that I pointed out when I was speaking about the benefits of AD&D. Strongly recommend, having both run alongside each other. Number one, if you're concerned about qualifying for life insurance, maybe because you already have a health condition and you may not be approved, there is no evidence of insurability for AD&D, and it's significantly less of a cost. Keep in mind, if you pass away due to an accident, it's little dollars in premium, but AD&D can offer that additional benefit in addition to any life insurance coverage you have. So one does not offset the other. And AD&D also pays a benefit if you experience a serious injury due to an accident where life insurance would not cover that because you obviously survived, even though there was a severity to it. So that's, the main reason why it's pretty important to have both lines of coverage. Next question that we have, and this was tied based on the timing that it came into some of the policies that Chris was walking us through. And the question was, I assume Prudential offers all of these kinds of policies. So Chris, do you want to confirm that? And, or I can just confirm it. Obviously, Yep. It's not under the group chassis, and there may be some things that we'd recommend, consulting with a financial advisor on. So it's not offered through the group-sponsored AFSPA chassis, but Chris, do you want to add anything else about just Prudential in general?
Yep, just about anything we spoke about today in the presentation, or at least during my portion of it, is available through Prudential, is available through myself or just, or actually, many licensed financial advisors.
Thank you so much. We have another question here that says, I'm getting ready to retire, and I already signed up for, I'm assuming it's Medicare Part B at 65. I'm not sure what to do next after I retire. Chris, what would you recommend?
That is a loaded question, if I've ever heard one. There is a lot of things to consider. One, especially if you're in the federal government, whether or not you even need to sign up for Medicare Part B. Then you have to start thinking about how you're going to pay for it. Are you going to take Social Security or are you going to not? You got to think about what are you going to do with your TSP. You have to start thinking about, again, on the Social Security thing, do I delay it in terms of taking it at a later age? You have to start thinking about healthcare expenses, long-term care, estate planning, where you're going to live, how much you're going to spend, what's sustainable. Unfortunately, there's just too many questions to really answer in just one conversation. But what I can say is, that's my area of expertise. It's what I deal with on pretty much 100% of my time, usually with at least one person being in the federal government. So if that is something that is of interest to you and you're looking for a more personalized answer, I would encourage you to use the survey that'll come up after this thing concludes. You just put in your contact information. We'll reach out to you, and we give everyone in AFSPA a free one-page plan that kind of can help them think through what they need to be doing and take it from there.
Great. Thank you, Chris. And I also just wanted to add, tied to the prior question where we were talking about GAP plans, while it's not a disability program, I would like to just promote, outside of the Prudential group insurance offering, AFSPA does offer several disability insurance options, and you can email AIP@AFSPA.org or visit www.afspa.org for a little bit more information. And again, we'll release this when we release the full transcript, so you'll have that available at your fingertips. Looks like we have, we're going to take probably about one more question. And then from there, thank you all who may have submitted other questions. We will make sure to provide those in the transcript, but we do want to be mindful of everybody's time today. But the last question relative to the group life insurance is, when can we apply for dependents? I'm assuming that's dependent coverage. And then it says, does it have to be when we are hired? So you can obtain dependent coverage for your dependent children, the qualified children, as we walk through, at any time, as you may not have children at the time that you initially apply for coverage. As a member, you must be enrolled for coverage to be able to secure dependent coverage, but there is no evidence of insurability required to insure dependent children. And if you want to increase your own coverage because you do become a parent at any time after you've already enrolled, or, just in general, if you're not already enrolled in the program, within 60 days following the birth of a child, which is what we consider a qualified life event, you can enroll for up to $200,000 for yourself without medical evidence. So great question, lots of nuances in the program, but there are a lot of different options for you to make sure that you have adequate coverage for yourself and your loved ones at the time that you need that coverage. And we're just about at time, so once again, on behalf of myself and Chris and the entire Prudential team, we'd like to thank the AFSPA benefits team first for being great partners to us, for making sure that they're bringing great information to the population, and also for making sure they're choosing the best suite of benefits for all of you, and then to all of you as the members. We couldn't do this without you, and your engagement, your participation is always key. So thank you for caring enough to join today, but also more importantly about your own financial wellness. We wish you all a great morning, afternoon, or evening, depending on where you are. And again, thanks so much. Here.